This is actually the cheapest lithium names have ever been at any point in any cycle. Lithium is now the cheapest sector relative to precious metals, oil and gas, utilities, basic materials in 2025.
Welcome back to Rockstock Channel. In the last of 3 videos we'll be publishing from Fastmarkets Lithium and Battery Raw Materials Conference last month. Today's video features David Deckelbaum, a leading sell-side analyst at Cowen Co. Cowen is a full-service, publicly traded American investment bank that's been around some 100 years. Cowen is known as a research-driven firm with a big focus on ESG. Based in New York, David began covering the lithium and rare earth space in earnest about 2 years ago. He has the perspective of an oil and gas analyst, which he's covered for many years and still covers. He leads Cowen's Next Generation Materials Research Initiative as part of the firm's sustainability and energy transition practice. Cowen has published several deep dive pieces on lithium, including Albemarle, Livent, Allchem, Lithium Americas, and Piedmont Lithium. Cowen regularly hosts mini conferences featuring lithium producers and developers, as well as expert calls. RK Equity partner Rodney Hooper and Fastmarkets Will Adams presented to Cowen's clients last month. David wrote on July 1st a summary of his takeaways from the Fastmarkets conference. He cited Eric Norris, Albemarle's president of lithium, highlighting that lithium producers must double output every 2 to 3 years to meet 2030 demand of 3.2 million lithium carbonate equivalent tons. Toward that end, Albemarle, following Piedmont Lithium's strategy, articulated a plan to process 100,000 tons of lithium chemicals in southeastern United States using spodumene feedstock from Kings Mountain, North Carolina, and possibly elsewhere. Similarly, SQM's Philly Smith said that 200,000 to 300,000 tons of lithium will be needed annually, equating to 8 to 10 new projects per year. If you find value in this and other Rockstock Channel videos, please consider joining our growing list of Patreon subscribers. And at the very least, make sure to subscribe to the channel and click the notification bell if you haven't already done so.
Thank you, and thanks for everyone at Fastmarkets for having me. I promise I will try to make this presentation sexier than just pricing and investment structures. I just did not have a pithy title. I sort of subtitled it Pricing as Lithium's Own Limiting Factor, obviously riffing on the idea that lithium is inherently a limiting factor to EVs. The context of this presentation is really, at the beginning of this year, I'm a research analyst for Cowen Company. We're an investment bank. So I publish investment opinions on lithium producers, rare earth producers. I also follow the oil and gas industry. So publish things on the macro side as well. The intention of this report was really looking back at the beginning of this year. We published that we thought that the next inning of the lithium bull market trade would be resetting the way that pricing is contracted and the way that supply agreements are struck. And that ultimately we want to look at visibility being one of the missing elements in the lithium space that's really critical to create, bring this industry from a relatively nascent state in the investment world to one that would be relatively mature. So I want to thank everyone in general just for opening their arms for another Wall Street analyst to opine on an industry that's near and dear to their heart. So what are lithium equities pricing in? This is probably one of the more common questions you get as a research analyst is everyone looks at the spot price and sees $70,000 and says that it's not sustainable. And then they wonder what price you're actually embedding in the way that you're valuing a company. It's for context, lithium equity valuations have already compressed, by over 50%. So this is actually the cheapest lithium names have ever been at any point in any cycle. Despite the fact that you have this monster supernormal secular demand function that's happening, which is extremely unique to lithium and several of the EV sort of derivative trades. But with several of the other precedent panels that were up here, you can think about lithium really being one of the more singular lithium limiting factors to that trade. So we're closer to about 5.5 times on next year's EBITDA right now. It's certainly the lowest that we've ever been, and you can clearly see departing from fundamentals, particularly price. But hitting it more on the nose, what are we pricing in? When we look across the 5 major producers that we cover and some of the non-producers, you can arrive at that answer a variety of ways. One is by looking at most of the time these names can trade at anywhere between 60 to 70% of NAV when things are mature, which would be a highly visible discounted cash flow function Right now, most of these names are trading between 35 and 60% of NAV. And that assumes long-term pricing that's heavily discounted relative to where spot is today. We think that most names are implying between 15 and 25,000 a ton, which certainly is well below any indications that public producers have given of what they're going to realize this year, certainly well below elevated spot levels. And the equities are truly trying to, obviously trying to discount something that's out there. So you can look illustratively, that gray part on the bottom is just sort of a using benchmark of a Chinese lithium carbonate pricing. You can see that actually it's not so bad. Public lithium equities, it might feel like we're in this bear market, but you're only down about 2.5% year to date. So you've beaten the S&P by 16%. You've beat battery charging names by 26% and electric vehicle names by 29%. We don't necessarily always want to be, the tallest short challenged person or height challenged person in the room, but this is a relatively winning outlook, I think, for most investors, and certainly as part of a derivative trade of broader broader companies that are leading the demand center here. If they're down more than you are by leaps and bounds, it's not so bad. But the sector is perhaps in the midst of this radical departure from fundamentals, and just given the relative outperformance that we've seen, last year we sort of looked at it as 2021 was the year of the easy trade of being, I heard EVs are going to be a thing, and I also heard that they require lithium, so therefore I will appreciate this equity by 300%. It's harder now. The easy money has been made. And I think as we consolidate these views, there's never been a more sensitive or susceptible time to bearish market calls, short reports, because there is no catalytic event that's coming other than potential supply coming online, China necessarily restarting, and looking for indications of the spot market that something's changing. Investors continue to debate the importance of what the spot market actually means, considering that many estimates, including Fastmarkets, say that only about 5 to 10% of the market is traded on spot. So it's not really a helpful indicator. Obviously, as more volumes come onto the market, you'll see more spot volumes as a percentage of that composition. But when you consider the other investable attributes of the lithium sector, you have widespread government and policy support. You have supernormal demand growth. You have a real disruptive shift in the way that consumers are purchasing things. What it lacks at its core, in our view, is clarity. Every single fundamental valuation principle, whether it's a PE ratio or an EV to EBITDA or a DCF, they all require duration. Everyone's looking for the duration of something, and everything that we've heard about today in terms of disruption says that at least for the next 10 years, whatever we're looking at is gospel. And if anything, we're underestimating some of the inefficiency on the demand side. So if you have 10 years of high degrees of visibility, how do you match that as a lithium company as you espouse fundamentals to the market? Let's look at where we are now. These are common lithium disclosures from 6 of the major publicly traded names in terms of market cap. Only half of them tell you how much they produce every quarter. Only 1 gives you explicit price guidance every quarter. Only half give you pricing received. They only sell 1 product. Shouldn't be that hard. But we're in the dark here. We don't have pricing guidance. People speak in percentage terms. They don't tell you what product they made. And Allchem has certainly been the most visible and most clear with the way that they've guided the market. If you look at the larger peers like BHP and Vale and Rio Tinto that everyone wants to come into this space and bless it as this secular investment theme, BHP gives you 7 different products every quarter. Prices for each individual one. Vale gives you margins, price, volumes. Rio Tinto has 6 other elements, and I understand that this is a specialty market, but there are aspects of these markets that have specialty characteristics in them as well, that are still qualifying with OEMs, that are still qualifying with end users, and these larger companies that are 15, 20 times the size of most lithium names do not struggle to provide explicit guidance. So let's look at the pricing gap in a historical context, is getting back to the relevance of what spot means. Here we look at our coverage relative pricing or realized pricing, which again is actually an estimate because we don't actually know what these companies produce every single quarter, so we're backing into everything. So I'm reverse engineering everything that I'm modeling constantly. And I'm doing that to a revenue number in many cases. Spot's always proven to be a reasonable benchmark with discounts for obviously quality, timing, duration, contracts. If you look on the hydroxide side, companies like Livent have realized pricing in the past that's roughly correlated to a 15 to 20% discount. So certainly it's an informative tool, but it's not giving you everything, excuse me. So let's look at the way that companies are calling for higher pricing. Albemarle tells you it's going to be up 100% year over year. You don't know where it started, so that doesn't really help me other than saying that things are going higher. Livent told you what their revenue is going to be, up 91%. But again, you don't know how much they produce on a quarterly basis, and you don't know what their realized price is. Allchem's the only one that told you that June should be 35,000 a ton for their carbonate out of Olaroz and 5,000 a ton for spodumene. And SQM gives you more color around demand and macro and why you should be bullish EVs instead of talking about what their core business does. No offense. Let's look at a common look at common lithium pricing mechanisms. Obviously, everyone uses a mix of historical fixed price contracts that we're rolling off of now. You saw the realized price chart before. Albemarle, obviously, in a period of weakness, was realizing premiums based on fixed. They were then realizing discounts based on concessions that they were giving the customers, and a lot of what we saw in the beginning of this year was rolling off those concessions. You look at Albemarle told you that for this year, 75% of their lithium sales are going to be battery related, with 20% on short-term contracts, 50% variable, and 30% fixed. It's not, it's not insurmountable to guide around what those price points are, but obviously we're all moving towards an index function, which is great, except for the fact that this business is still very capital intensive, has no virtual way to hedge. So you're actually exposing yourself to the spot market where I think you should be locking in duration, considering that supply surety is what everyone is talking about right now on the OEM side. So it's one thing to lock in offtake agreements to promise things at index prices because now you have visibility into spot, but you don't really because we don't know what price you're realizing every single quarter. So this could be a setup where the markets push for this because we want to see, obviously, lithium companies that have been realizing $15,000, $20,000 a ton getting closer to that 70 that you see on the screen. But look what's happened. You look at comparative valuation versus other sectors and growth expectations. You can look at the EV to EBITDA multiples on the top graph. Lithium is now the cheapest sector relative to precious metals, oil and gas, utilities, basic materials in 2025. And that's even after other sectors like oil and gas have had pretty heroic increases in commodity prices. This implies that either perceived growth will be short-lived, capital funding will be too dilutive, or pricing will have to adjust lower. If you look on the bottom plot, you can see that obviously lithium, which is that nice bright blue graph, that bar on the right side, has growth estimates that you really only need to approximate in order to become bullish on the sector. OEMs have plenty of partners that they tell us about in the industry. We've seen everything from mine investments out of BOID in Africa. We've seen GM contracting for offtake with CTR and geothermal. We've seen offtake agreements with Ford and Lake Resources. We saw Stellantis obviously increase their offtake and actually take an equity stake in the company in CTR. We've seen Tesla and Liontown, but offtakes offer very little value to investors. They've yet to migrate to take-or-pay contracts, and surety of supply, in our view, should come with a commitment of capital. Offtakes in other areas that are part of the EV derivative network, like rare earths, have actually been take-or-pay, or include financing and support, such as Linus and JRE, or MP and GM, in terms of explicit offtake and fixed pricing. Offtakes might have been a good marketing tool in the past, but I think it's probably well understood at this point that if you're producing lithium and you're creating a battery-grade product, that an EV manufacturer is going to be buying it. So again, this is a list of OEMs and the number of battery partners that we see in the public domain where even names that don't have any offtake agreements have at least 5 or 6 battery partners on the lithium-ion side, even have publicly announced solid-state battery partners, and all of these names are targeting getting to electrification between 40 and 50% globally by 2030. You have all of this capital at risk on the OEM side without a hedge. On that left chart there, you see the percentage of R&D CapEx being spent by OEMs right now on EVs, with many names well above 50%. On the right plot, you see that there's over $500 billion total, if you aggregate it up across EVs being spent by OEMs on EV manufacturing. And yet our supply-demand model, which we actually think is conservative, suggests that at least 10 to 15% of EV deliveries on the bottom chart between 25 and 27 are at risk of coming to market, with 30% at risk in 2028 and beyond. Risk should be hedged. And you see the supply chain up here becoming further constrained ex-China, as right now I think it's lost on most investors that China actually comprises 56% of the EV market, being supplied by mostly Chinese battery manufacturers. Recent Chinese shutdowns should still result in year-over-year growth in EV deliveries to China by 20% year-over-year. And ex-China demand should contribute to long-term growth in everyone's models, but we don't have any of the infrastructure in place. And just given the nascency of investments here, this is I think, an understated heroic achievement that needs to take place. So one of the things that we look at from an investment perspective or contract perspective is what's called a cash and carry model. OEMs lack the ability to hedge price and supply, right? Most recently, Stellantis and Vulcan, I think, started to show us a glimmer of what we might see, where you saw Stellantis taking an 8% equity stake in the company. So it's helpful because it's a vote of confidence. You get a brand name, you have a partnership, and it makes sense also if you're co-locating labs and you're working on battery qualification. There's a lot within that partnership, I think, that can be quantified. A cash and carry JV model doesn't require fully OEM ownership of lithium producers. I think a lot of people talk about lithium names or OEMs buying lithium mines. You don't need to own a lithium mine. It's not within your core competency. But you should be fronting a portion of the economics and being able to hedge your actual supply chain. A cash and carry model obviously would alleviate upfront CapEx concerns. It would validate valuation. If I get a mark and someone's going to give me $500 million for, I don't know, a 10 million ton mine, I can work into like my resource what that means for the inherent equity. And I can back into what price that OEM might be willing to underwrite. And then I don't have to think about, what about demand destruction? What does lithium comprise of in terms of a total EV cost? And you'll get answers from all over the board. I don't have to think about that if I actually see capital being committed. And it ties the customer obviously back to the success of the project. But most importantly, it illuminates the economics of this project to investors. Just illustratively, we look at cash and carry JV structures that have been used widely by every natural resource company out there. They obviously defray exploration and development CapEx up front in lieu of things like equity financing. In many cases, the sunk cost defrayment can increase IRRs by up to 20%, if not greater. Obviously, if you take upon 100% CapEx at a project level and get 50% of the economics, you can see almost a double or more in the inherent IRR. When you consider the fact that what's most detrimental to IRRs in lithium projects would either be delays, which on average have been close to about 18 months, and that's probably being generous, but looking at historic DFSs and when things came online. And then CapEx, which in many cases has been at least 30% over the PFS once you get to DFS, which would eat into your returns by at least 8% of each one of those categories. So a key benefit here is the implied valuation given by the lender or the investor and the inherent financial benefits. So sort of our pricing plan of attack. To increase disclosures, you should be able to show average pricing and floors and ceilings estimated on an annual or quarterly basis and a range of outcomes given spot markets or index prices that you happen to be looking at. Fixed price contracts, in our view, should be struck at premiums paid for duration, and those prices clearly communicated to the market. Disclose reference pricing obviously used for various indexes, and embrace partners with creative solutions instead of looking for government loans and grants. OEMs need the product. They should be footing a portion of the bill. We looked at the $500 billion plus that's out there in the market. When you consider the only about $20 to $30 billion needed for lithium to actually increase supply over time, this is a rounding error. And at the project level, every OEM should be proud to be associated with public producers that are executing on time and helping them to get to the end stage. We've seen it in other materials. We think that this is the next thing for the lithium market. Pricing in a constrained market, in our view, is not proprietary. It is a specialty chemical product. But if we're undersupplied every single year by 30%, your pricing is not your trade secret. Nor should it be, else investors refer back to commonly cited cost curves that are relatively meaningless in a demands market that we cannot keep up with that outpaces supply secularly.